Hi, my name is Fatin Ayuni binti Muhammad Ali.
Hi and Assalamualaikum. My name is Nur Syaira binti Rizwan.
Hi everyone, my name is Nur Zulaika binti Masran.
Hello, my name is Nur Hanisha binti Nur Azmi.
Hi, my name is Nurul Atira binti Harun Musakir.
Insurance is a contract in which an individual or entity receives financial protection or compensation from an insurance company in the form of policy. The company pools the risk of its clients to make payments more reasonable to the insured. There are life insurance, health insurance, and general insurance. These types of insurance have their benefits and functions itself. Let's take a look at insurance functions and insurance benefits. There are 3 types of functions and 5 types of benefits in insurance.
Here are the 3 functions of insurance. First is primary functions, second is secondary functions, and thirdly is indirect functions.
The first function of insurance is primary function. The primary function of insurance is to act as a risk transfer mechanism. Insurance acts as a risk transfer mechanism where the insured, in exchange for protection, pays a sum of premium to the insurance company and transfer for responsibility of loss and damage to the insurer. Upon acceptance of the risk, the primary insurer is in the same position as the insured in relation to the various uncertainties associated with the risk.
Moving on, the first point is release funds otherwise tied up in reserve. This is through the purchase of insurance, businesses, enterprise, and individuals are able to avoid the necessity of raising capital. This to provide financial protections against losses to the fund release will be available for investment. Next is stimulate business enterprise. This risk transfer mechanism provided by insurance has made possible and helped to maintain present-day large-scale industrial and commercial organization, such as large-scale enterprise could not have started without transferring many of their risks to the insured. Other than that, reduce worry and fear also is one of the secondary functions of insurance, where insurers help to remove fear and worry over losses for individual and business. The removal of fear and worry over such losses help to give the insured peace of mind. Furthermore, reduced losses also is one of the secondary functions insurance, where insurers help to reduce losses both in frequency and severity through their actions and recommendations in rating, survey, inspections, and salvage activities. Next is encourage saving. Encourage saving is to protect insurance offer a guarantee cash value either at maturity or at death in exchange for the payments of premium, where insurance provides saving and protection. Lastly is social benefit. Insurance benefits society indirect through compensations paid by insured to insured, which reduce the cost of social service.
Lastly, in function of insurance, it has indirect function, which is investment of fund. Insurers accumulate large fund which they hold as custodians, out of which claims are met. These funds are usually invested to earn interest or income in the public and private sector. For second one is invisible export. Insurance can contribute considerable to a country balance of payments as an invisible export. For example, while Britain is a net exporter of insurance, Malaysia is a net importer of insurance. The lastly is a source of employment. The insurance industry in Malaysia has generated numerous employment opportunities through the creation of jobs such as underwriter, claim officer, and loss adjuster.
And next, I will continue about benefits of insurance. If you are wondering whether it makes sense to buy life insurance, ask yourself first, would my death leave anyone in a financial bind? And if your answer is yes, then it may be time to get serious about shopping for life insurance. Life insurance can offer peace of mind that helping to ensure your debts or loved ones will be financially taken care of in the event of your death. Medium-sized and larger firms could certainly create reserve for emergencies such as fires, thefts, or serious injuries. However, this money will have to be accessible reasonably quickly, and hence the rate of interest which the company could obtain would be much less than the normal rate. Because of the effects of the common pool, the business is able to purchase insurance at a premium which is less than the fund that the company itself would have to retain, even assuming it could retain anything in the first place. The premium can be looked upon as a certain loss to the business, but the firm is now free to continue its business and invest in the knowledge that certain risks are now provided for. With this peace of mind, it can develop its business activities. Next is loss control. Loss control is the proactive measures taken to prevent or reduce loss evolving from accident, injury, illness, and property damage. For example, imagine there is been a burglary in your neighborhood, so you decide to install a monitor security system in your home. Because your new alarm system protects your family and property from damage, which is loss, it can be thought of as a loss control. Loss control can help minimize the potential for injuries, property damage, and other liabilities. By reducing the frequency and severity of cover losses, loss control saves insurance company money. In return, insurance companies reward policyholders with lower insurance premiums. It's a win-win situation. For example, many insurance companies offer a substantial discount on a home insurance premiums for installing a monitor security system because it reduces the chance you will need to file a theft claim in the future. Similarly, implementing safety training and laboratory safety software in your organization can result in significant savings on workers' compensations and liability insurance. Without loss controls, claims may occur more often than expected or with greater severity. In this case, your insurance company may even raise your premiums or decide not to renew your policy. If you are self-insured, then you are bearing the full brunt of the cost of a loss, which is often even more painful and expensive than dealing with an insurer. Loss control also can minimize frequency and severity of accidents. It can reduce expenditures of insurance claims, minimize interruptions of service provided to the public, provides a safe environment for employees, and provides a resistance against claims of negligence.
Now, we move to the next insurance benefit, which is social benefits. By having insurance, it gives us social benefits. Social benefits of having insurance is when, in the case of losses, people still can keep their jobs where their source of income are maintained and able to continue in contributing to the economy. In addition, the premium that is paid by the many insured will not only cover their own losses, but the accumulated premium will cover the other losses. This is because the group shares the risk using the common pool concept method, which is it takes contributions in the form of insurance premium from many insureds and pay for the losses of a few. Next is investment of funds. Insurance companies have at their disposal large amounts of money. This arises due to the fact that there's a time gap between the receipt of a premium and the payment of a claim. A premium could be paid in January, and a claim may not occur until December. The insurer has this money and can invest it. In fact, an insurer will have the accumulated premiums of all insured over a long period of time. The use of this money within the economy as a whole is one of the benefits because both the government and industry have access to a large pool of working money. With accumulated premium, insurance company will invest it and make another profit. This money is the result of thousands of different people and organizations paying premiums, and in one sense, the existence of an insurance market really brings about a form of enforced saving. For example, if we consider a person insuring his or her house, such a person may not have sufficient free money to be able to purchase shares, buy property, or lend money. However, when the premium from that person is added to the premiums from several thousands other people, then a reasonable amount of investment money is made available. Last but not least is invisible earning. Invisible earning is one of the income that generated by an insurance company from a foreign country through the invisible trade of goods or services, including exporting insurance. In a modern economy, we import goods which our people need, and by the same, we export goods which other people want to buy. Where these goods are tangible, a visible trade exists. For example, when goods are shipped to a foreign country and are paid for by that country, these are visible exports. In the case of insurance, the goods are invisible, but the principle remains the same.
Every individual should get insurance to protect their well-being. People can take a variety of insurance options based on the requirements. To summarize, purchase insurance to protect your life and valuable assets from unforeseen circumstances. It is important to have in mind that the functions and benefits of insurance are to protect what you value. In life, there are no guarantees or certainties. There is no guarantee that the company will not experience a loss or harm due to unforeseen circumstances. While we cannot protect our interests against all dangers, we can purchase insurance to cover some of them.